Welcome, everyone. We're so glad you can join us for this on-demand webinar hosted by JFL Total Wealth Management to discuss reverse mortgages. For some retirees, especially those with much of their net worth tied up in their primary residence, a reverse mortgage can provide a much-needed income stream. Today, JFL's Jeannie Kane and reverse mortgage expert Darren Murdoch of Family First Funding will go over the what, why, how, and how much of reverse mortgages. Our goal is to educate you on the basics so we can follow up with a more in-depth conversation regarding your individual financial situations. Without further ado, let's introduce our two panelists. Jeannie Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing JFL's private clients' portfolios and with developing comprehensive financial plans. Darren Murdoch has been a reverse mortgage consultant for nearly 2 decades, where she combines her head for finances with her heart for social issues and a master's in social work. She works for Family First Funding and is dedicated to helping improve the quality of life for seniors. Welcome.
Welcome, everyone.
Thank you. Thank you. Welcome to everyone.
All right. Well, Jeannie, can you take it away?
Absolutely. Thanks, Gretchen. So at one point, reverse mortgages kind of got some bad press. Now, we firmly believe there are no bad products, but the products can be used inappropriately and used in the wrong situations, and that can create problems. So we have many clients who have reverse mortgages. In fact, Jerry's mom has one herself. And a reverse mortgage, it really has to be a good fit for it to work well. Now, if you own your own home and you die, say you have kids, the kids inherit the home, and 9 times out of 10, they're going to sell that home. And all of that equity that was locked up in the house, and during that time, while you were alive, you weren't able to tap into it. A reverse mortgage is a way to allow you to really to tap into and take advantage of that equity. Keep in mind, a dollar is a dollar is a dollar. And if we pull a dollar out of the equity in your home, it's really the same as pulling a dollar out of your investments. So today what we're going to do is we're going to start by talking about the one-on-one, kind of the basics of reverse mortgages, how they work, how to become eligible, and how you can get your money. Then we'll talk through some strategies and ways of using the funds from your reverse mortgage. And then finally, we'll follow it up with talking about the application process. So right now I'm going to turn it over to Darren, and she's going to start with the one-on-one.
Thank you, Gretchen and Jeannie, for that very warm introduction. I'm so happy to be here. And let's start with what is a reverse mortgage. What a reverse mortgage is when we convert a portion of the home value into tax-free dollars. And we're talking about the government loan, which is even better because it's a non-recourse government-insured loan, and I'll explain a little bit more about that later. But what you're able to do is you're able to take some cash right at the closing if you so desire. You can get money on a monthly basis, and one of the plans goes on indefinitely. You can leave money in a line of credit and draw on it on demand whenever you like, or you can do a combination of all three. And it's a very, very flexible loan. So let's take a look at what are the eligibility guidelines. The first one is the minimum age requirement for a reverse mortgage is 62. However, if you are a married couple and one person is 62 and one is under the age of 62, you can still get the loan. If there are 2 people that are not married living in the home, then they would both have to be 62 in order for both of them to be on the loan. The second thing is we want the home to be your primary residence. You want it to be a place where you really want to stay and live at least for 5 years. Single family and multifamily homes are eligible, and some HUD approved condos are eligible. So that's something that you can ask your lender. So in other words, you have to be on the deed of the home. And some people like to do some estate planning in which they only retained a life estate that is eligible, and some trusts are also approved for reverse mortgages. The third thing is you have to complete what's considered a mandatory counseling session by a HUD certified counselor. And this is for your own safety. You'll hear from your loan officer all of about the numbers and how, the costs and the interest rates and everything. But then you get to go and have about a 40 to 60-minute phone call with a HUD certified counselor that will go over those same numbers for you, but they're an impartial individual. They have no bias of whether you get the loan or not. So this is a really good reassurance and hearing it from another person's perspective. So they'll go through all of those details, and that really helps tremendously. It's a good safeguard. The fourth thing, we call it financial assessments, and there's two things in financial assessments. One, we will look at your credit over the last 24 months to assure that you haven't been more than 30 days late on your bills. And the other is you have to meet certain income thresholds, what your income is, subtracting out some of your major household expenses, and you have to meet certain thresholds. If you don't, if you're late on your bills and it's not just a one-time thing, it's an ongoing thing, it doesn't mean you can't get a reverse mortgage. It just means that the lender will have to set money aside for taxes and insurance over your lifetime to make sure those bills are paid on time. Now, once you have the loan, let's talk about the covenants of the loan, what you are committing to. You're committing to paying your property taxes and your homeowner's insurance on time, that you're going to maintain the home from major disrepair. We're not talking cosmetic, we're talking just, the roof. If the roof is leaking, you'll get it fixed. If the furnace is needing repair, you'll take care of that. It will remain your primary residence. So you want to do this not on a vacation home, but on your primary residence. And you cannot rent it out. So primary residences don't get rented out. So just, keep those things in mind. There are also some financial and social considerations to take into account when you're thinking about getting a reverse mortgage. What are the costs for the upkeep of the home, the yard, the snow removal, interior cleaning, appliances? I think I just touched on like roof and furnace and, things like that. But you also probably want to reflect on your health. And if it's a two-story home, is this something that you feel that you can manage over the long haul? Is it easy for you to get up and down stairs? Are you near your family? Do you think you might want to move to another primary residence soon? Is this something that's just going to be a Band-Aid for a year or two, or if it will sustain you over the long haul? So those are really good things to start to reflect on. Now, the question that everybody is always interested in is, how much money can I get on a reverse mortgage? Well, that's going to be different for everyone. We're going to look at the age of the youngest applicant, the interest rate on the day that you apply, the value of your home up to the government imposed lending limit. And all of those things go into a government formula. It's a 4-page formula, and it will determine what you are eligible for. So on this slide, you're seeing an example of someone that's living in a $500,000 home. And on the left column, you'll see age 62, age 70, age 80. In the middle column, if you were 62, you would have net of fees about $215,200 available to you. And you can see the 70-year-old and the 80-year-old, what they're eligible for. You can see as you grow older, you're eligible for more money, okay? Because the actuarian tables say that your life expectancy is shorter as you grow older. Now, the last column is something I really want to point out. It's called a monthly tenure advance. And what that means is if you said to me, what is the most that I could get each month that's also guaranteed never to end as long as I live in the home, or as long as one of us live in the home, how much would that be? Well, in a $500,000 home, a 62-year-old could get $975 forever, as long as you're living in the home. And you can see the 70-year-old, it would be a little bit more at $1,210, and the 80-year-old a little bit more at $1,711. So that's something to take note of. Now, there are various distribution options. You don't have to do a monthly tenure. You can take a certain amount right up front at the closing if you so desire. You can leave the money in the line of credit. And the beauty of that is, number one, you're not charged for it. It's growing tax-free. You have access to it anytime you want. And and you can take it on demand. So if you don't need money every single month, that's a really, really nice option. The third one was the monthly tenure, which I just spoke of. What's the most you can get that's guaranteed never to end? But what if you don't want the amount that we determined that's guaranteed never to end, and you want more than that? You can take more than that. It's called a monthly term. And you can set the dollar amount that you want, and it can last for a finite period of time. And then, of course, you can do a combination of all of them, which is a really, really nice thing on this loan, that it's so flexible, and you can, stop a monthly advance and put the money back in the line of credit. You can switch it back and forth depending on what your financial needs are. So now let's move over to the strategies for using reverse mortgage funds. And this is so diverse that I'm only just skimming the surface and touching on a few. One is you could use the proceeds from a reverse mortgage to buy a vacation home, and so that you have a nice place to go to in the cold weather. You could also use a reverse mortgage to purchase a new primary residence. Yes, you can do that. Lots of people that are downsizing are using that strategy. Another thing that you can do is you can use the funds to fund long-term care expenses if you need care in the home, or you can even use it to fund the long-term care insurance policies that you're getting, so that you are protected. You're protecting the remainder of your estate. So you can think about that. I've seen people gifting it to loved ones. I've also seen a great strategy where, when people were taking more than the minimum distribution out of their IRA, they reduced it to the minimum distribution, supplemented it with some monies from the reverse mortgage, and reduce their taxable events. That's a really nice strategy. And you can talk with your financial planner about using the reverse mortgage as just one tool in your toolbox of all different options to enhance your financial well-being. And it also, obviously, it helps you to sustain yourself and live in the home where we all really want to stay, right? So let's take a look at, what does it entail? What can you expect when you want to apply? Well, the first thing you should do is contact, a loan officer, somebody that can actually run numbers for you and run a proposal, a consultant, such as myself. And they will run the numbers, and they should spend some time explaining everything, soup to nuts, in your particular situation. If that feels good to you, and it feels like it makes sense, and you've spoken, maybe even consulted with your financial planner about how this fits in your whole strategy, then you call and you get yourself scheduled for the counseling session, and you hear about it from the counselor's perspective. And once that's done, then you can apply with the lender. You cannot even apply until, well, actually, what I'm saying, you can apply before the counseling is done, but I don't recommend it. You should do the counseling first, then apply, and then after that, the appraisal is ordered, title search, credit report, all these things. Once the appraisal comes back, and we know what the true value of the property is, the numbers will be recalculated. And that's when you make a decision on whether this is the right thing for you, because you really can't make a decision until you know what the value is and what the bottom line numbers are, right? That makes sense. Finally, I'd like to go over some of the advantages and I guess you could say disadvantages of a reverse mortgage. Let's go over the advantages first. There are no monthly mortgage payments, so it's improving your liquidity, which is a beautiful thing. The closing costs and any ongoing fees are all financed into the loan. You don't have to pay anything out of your pocket. All of the funds that you're receiving from a reverse mortgage are tax-free and they are not considered income, so that you do not put them on your tax return. And then after the loan is repaid at the end, like when you are no longer living in the home, that is when the loan has to be repaid in full within 1 year of leaving the home as your primary residence. Then whatever equity is left over goes to your heirs. If you decide to sell the house, you pay off whatever debt you have from the reverse mortgage, and the rest of the money is yours. You always retain ownership to the home and any equity that remains available to you. And finally, in the very beginning of this conversation, I mentioned that this is a non-recourse government insured loan. And this is a very, very important point, because I would not do this for a living if this piece was not on the loan. What this means is if you end up owing more than what the house is worth, right? If you borrowed a lot of money early on and interest accrued and you lived a really, really long time and you ended up owing more than what your house was worth, whatever the house is worth, whatever the fair market value of the home is, will satisfy the loan in full. So in other words, you cannot leave a burden of debt to your heirs. It's a really important point. Now, what are some of the disadvantages? Well, as you borrow money, interest is going to accrue on that. So what you owe will go up in time, right? So you're going to owe more than when you first started out. It can impact some needs-based programs such as Medicaid, but it does not affect Social Security or Medicare benefits whatsoever. And you are using your home equity to live on versus preserving it for future inheritance. So I think that I'd like to sum it up here in that, it's really good to find out what the numbers are for yourself and sit down with a reverse mortgage consultant and dive into what your particular situation is, where do you see yourself down the line, and work with your financial planner as well with all of these important decisions. So thank you, Jeannie.
Thank you so much, Darren, for sharing your expertise. And again, you have over 20 years in this industry. So we really appreciate you talking to our clients and talking about kind of the 101 of how reverse mortgages work, who's eligible, strategies for taking funds out of the reverse mortgage, and then finally walking us through the application process. Now, if anyone has further questions, as Darren mentioned, you have the option, you can reach out to her or someone who's a specialist in this area. You can also reach out to us at JFL as well, if this is something that sounds interesting to you. Thank you so much for your time and have a great day.